Good afternoon, everybody. Welcome back to the BRICSONOMICS show here on the Think BRICS channel. My name is Ben Epstein, and I'm really thrilled that you guys are going to be joining us today. And we have a very interesting topic over the last few months. We've seen India's most recent free trade activity and how India has performed over 2025. We're going to see how these recent impacts and their four front trade strategy is going to shape India in the coming years. So, over the past 4 years, India has quietly turned itself into something very rare, a live laboratory for how a large emerging economy can redesign its trade relationships in a world where no one believes in a sort of frictionless globalization. In between 2022 and 2026, the New Delhi has signed and as well as deepened agreements with countries like the UAE, the United Kingdom, the United States, and the European Union, as well as countries like New Zealand too. And this has all built a very dense web of strategic arrangements that India also already has with the United States, all while keeping one eye on the experiences domestically, but also how these experiences will teach policymakers in Brasilia and Johannesburg and Jakarta and Nairobi. So today we're going to walk through how these interlocking projects are not just used as sort of trade diplomacy, but also to show that it's not to surrender someone else's template, but to create a sort of instrument of industrial strategy, monetary innovation, and coalition building with South South countries. So let me start with the UK United Kingdom agreement. So, if you guys were not aware, this agreement came into force in 2025, and on paper, the macroeconomic effect it looks very modest. India's GDP is set to rise by roughly 0.06% over time following this trade deal. And a number that you'd think that is that small, you would wonder why anyone would even bother reporting it. But that actually misses the point. The point is that the UK deal was never designed to deliver a big short term boost. It's designed sort of as this template and a way for India to construct a new engine of a on a controlled track before scaling up the design for larger partners. So if we think of UK as sort of a high income country with a very strong demand for services, a relatively open goods market, and a post exit or post Brexit, need to demonstrate that it could still do these ambitious trade deals. For India, that makes it the perfect partner to sort of prototype this service first, phased goods, agriculture protected model. So, and this framework that we're seeing here with a north south framework that could be adapted for later negotiations with countries like Korea or Canada or even parts of Latin America. So, what's important about this trade deal is 99% of Indian tariffs into the UK are going to become duty free. So, it essentially drops it down to zero. Now, that sounds very dramatic until you realize the UK's tariffs were already very low on most Indian products to begin with. So the real gain is going to come in sectors where India has proven its competitiveness with sectors like textiles. So we'll see export growth there of, roughly 25%. Also, areas like jewelry and gems will have an expanded market access, as well as IT services are going to have new regulatory certainty and healthcare services, as well as telemedicine and diagnostics, sectors that India is already very competitive in. This trade agreement offers up this important opportunities for them moving forward. And very importantly, agriculture has been protected even more carefully using these tariff rate quotas. And it's designed to allow limited, tariff free imports to a certain threshold. And then after it hits that threshold, it's going to be a much higher tariff rates beyond it. So the long phase out of sensitive products for India, like dairy, where there's a lot of existential pressure from subsidized European and oceanic farmers, agriculture is something that even in this FTA, India maintained to protect it, which is very, very important. So, in terms of the investment that we're going to be seeing, so India has avoided the classic investor state dispute settler model, which allows foreign corporations to sue governments in private tribunals over often environmental or labor regulations. So instead, the UK, using India's post 2020 bilateral investment treaty template, which channels the disputes through these domestic courts first, um, and maintains explicit room for industrial policy and climate measures and public health interventions. For a developing economy trying to build a, capacity in things like green hydrogen or EV supply chains, solar panels, this policy space is not a luxury. It is an absolute necessity. So, who wins and who loses inside India at this point with this deal? Well, the big winners we're going to see, as we talked about, are the service exporters, IT professionals, textile manufacturers, and these pharmaceutical companies are the clear winners because they're going to find this market in the UK. Auto manufacturers, though, face a decade of managed adjustment. It's pressure, not necessarily a immediate shock. Also, dairy farmers are going to be protected in the short run, but they know that this protection will not last forever. So in the UK, consumers are going to get cheaper textiles and IT services, but maybe manufacturing unions could be worried about displacement, like labor displacement, even if the actual trade volumes increase. So now let's talk about the UAE's comprehensive partnership with India. And this was something that came out very recently, if you guys were unaware, that I find very interesting. So for context, the UAE is not a manufacturing powerhouse, but more importantly, it's a financial hub. It's a logistics gateway, and it's also a major investor with a lot of deep pools of capital looking investment that wants stable returns. And fortunately, India is a large, diversified economy, but has existing infrastructure gaps, needs for the energy transition that they've been working very hard in 2025 on, and also long term interest in reducing the dependence on the US dollar to settle trade. So, this agreement is going to go way more deeper than these sort of tariff cuts that that the agreement normally focuses on. Uh, Hi, director. I'm sorry. I think my slide is not moving. Maybe I can do it like this. And it's fine. We'll do it like that. So anyway, back to what we were talking about. Let's just start with the trade numbers, even though that it's a lot bigger than that. So non-bilateral oil trade with India and the UAE has risen from around $52 billion to roughly $100 billion over a few years, which makes the UAE one of India's top three trading partners. And Indian exports are led by textiles and gems and jewelry, pharmaceuticals, all these stuffs that we've already talked about where India already has a competitive strength in. But the but areas like the coordination and also the logistics and that market access is something that India and the UAE are really going to focus on, and that's something that the UAE brings as a huge part of this agreement. The rules of origin of this agreement are actually designed to ensure that the Indian value added is protected. So you can't just transship, Chinese goods through Dubai and claim duty free access to India. Now, on the UAE side, they're going to get refined petroleum products, industrial inputs, and more importantly, a deeper relationship in terms of food security because the UAE imports more than 80% of its food. So they obviously want reliable suppliers on that front. So now, in terms of the financial architecture of this deal, so a majority of the India UAE trade is already settled in rupees and dirhams, bypassing the dollar already, right? So that's saving India roughly about $2 billion per year in foreign exchange transaction costs, which is a modest sum in absolute terms, but symbolically, it's way more important because it demonstrates the impact of this local currency settlement and how feasible it is at scale between these two very large emerging economies. And it also reduces India's vulnerability to dollar liquidity shocks, as we all know, the kind that we saw in 2013 or 2022 when the Federal Reserve tightens and emerging market currencies come under pressure as a result. So, as think of this as like sort of a global safety net, right? If global liquidity dries up, India and the UAE have a bilateral channel that will keep things functioning. So, in terms of the investment of this deal, so UAE sovereign wealth funds are and private investors are committing more than $25 billion to Indian infrastructure, renewable energy, and port development. And this is not portfolio investment that can flee at the first sign of trouble. It is patient capital with 5 to 10 year horizons, often structured as joint ventures set up to align the incentives. So, India gets the capital it needs to build solar parks, green hydrogen facilities, freight corridors without running up short term external debt. And in return, the UAE gets returns denominated in a currency that's likely to appreciate over time as India's economy continues to grow at a record pace. So, India's trading this future growth for present investment, and both sides are trying to manage the risks between political alignment and these long term contracts. Now, similarly, textile exporters, pharmaceutical companies, infrastructure developers are big beneficiaries of this deal. And for the UAE, financial intermediaries, food importers, logistics companies, they are also benefiting. While for the UAE, obviously, their local textile producers are going to face new competition, though UAE's textile sector is, very small, in comparison. But to the bigger risk for India right now is the currency appreciation. So if capital inflows from the UAE and other partners are too large and too fast, the rupee will appreciate as a result. It'll strengthen. And as a result, their exports will be a lot less competitive in emerging markets, in third markets. So that tension is going to be very, very important for the Indian economy and economic chiefs to consider here. Okay, now now let's discuss the India's agreement with the European Union. Now, funny enough, we actually covered a agreement between the EU and Mercosur like days after it was finalized, and then they immediately rescinded it after I published the video. So I guess they were listening. I guess the European Union was listening to me. But in terms of the EU's also most recent agreement with India, sort of held as this mother of all trade deals, negotiated for more than a decade. It's coming as a result of the European Union is India's third largest trading partner by some measures, but it's also a regulatory superpower that is able to export its rules in their trade agreements. It's sort of like you could think of the EU template as sort of a software license. If you want access to this market, you're going to have to click accept on a long list of terms covering carbon standards and intellectual property, sanitary and phytosanitary measures, barriers to trade, but also digital governance and labor rights. So, for other developing regions from Mercosur to Southeast Asia are being asked to kind of click that same accept button. But for the question is whether you can negotiate the terms that will sort of revolution, industrialize your economy, but also do so in a way that is reliant more on renewable energies and fitting uh, your industrial policy within this sort of subordinate legal standard. Now, uh, the fact I don't think that this is as important of a thing as it was years ago in terms of the sort of agreements within. But let's just start with carbon in terms of this agreement. So the carbon agreement, so the EU's CBAM, which is the carbon border adjustment mechanism. This is still not working. I do not know why this is not working for me. Yeah. So in terms of the European Union's carbon border adjustment mechanism, it's designed to prevent what they call carbon leakage, which is like the idea of European companies might moving production abroad to avoid these climate regulations. And India's initial exposure to this was around $775 million dollars a year, which was very much concentrated in sectors like steel, aluminum, cement, and fertilizers, which is something that is, very, carbon intensive. And that exposure is going to rise and expand in more sectors. So for Indian producers, you either need to pay this carbon tariff, which makes you less competitive, or you invest in cleaner production technologies, which obviously will require capital and time to do so, which is why India is already building carbon pricing mechanisms and green steel capacity at the moment. But this transition to meet this standard is going to take a decade. So, in the meantime, this CBAM is going to act as sort of a de facto protectionist barrier by the European Union to sort of meet their requirements on carbon. So, in terms of intellectual property now, the EU wants India to extend the data exclusivity for pharmaceuticals. So that means when a patent expires, generic producers cannot use data to get regulatory approval for years. Now, India has resisted this because its pharmaceutical industry supplies affordable medicines of cheaper drugs, and as a result, to the global south, and as a result, it's going to delay the availability of these cheaper drugs and raise healthcare costs in India, but also these markets if they agree to this to this part on intellectual property. So it's not a technical dispute. It's a fight over whether these developing countries can use industrial policy to build competitive pharmaceutical sectors, or whether they had to accept these sort of intellectual property rules that are designed to protect incumbent producers in these high income countries. And lastly, just on quickly on visas and services, which was another flashpoint in this agreement. So now Indian IT professionals and service exporters are going to have a lot more predictable and streamlined access to the EU labor market. So the EU is offering this sort of limited liberalization mostly for high skill workers, but it's going to retain significant discretion to tighten up the rules on visas if domestic political pressures rise, which is frustrating for India because services are, the sector that India has a clear competitive advantage or comparative advantage, but its access is completely limited to to politics and goodwill. So, lastly, I want, or not lastly, let's quickly discuss just New Zealand, because New Zealand was a part of their agreements, but I'm not gonna make it a point to discuss it in detail. But the main thing with India and New Zealand was New Zealand has a massive dairy market, and that was a huge problem, a huge test case for these small agriculture or for these agriculture exporting economies. So for New Zealand in this case, I think what we need to see is even though that New Zealand is one of the world's one of the most efficient dairy producers, productivity levels are far above India's smallholder farmers right now. If New Zealand allows, and if New Zealand dairy products entered India tariff free, the impact on Indian farmers would be incredibly bad, very severe. Um, and the solution to this was sort of this tariff rate quotas that allow limited quotas of dairy, and then at a certain point, it would be a lot higher. But these phase-in periods for this idea of duty-free imports on dairy is going to be something that spans out in periods of 15 years. So, how India pushes for these duty-free access for goods like in engineering and pharmaceuticals and IT services, in return, they are going to be weighing a risk of New Zealand's economy because it's a lot smaller. The absolute gains are going to be limited, and the because of how they're structured, it matters a lot more to Indians' domestic base and farmers that they create this tariff strategy that allows them to import, but at the same time protect their base simultaneously. Now, um, as the last agreement that we're going to talk about before sort of talking about the so what of all this and bringing this all together, as we know, the United States and India have been going back and forth on a trade deal, and most recently, they have dropped tariffs down to 18% after it was originally 50%. So the important thing from this is the United States sees India both as an important partner in uh, sort of the Eurasian sphere, but also for a source of IT related services, electronics, um, and hedging away and diversifying themselves away from China's manufacturing, gravity. Because as we know, China has a massive, is the world leader in manufacturing in many many sectors. So India is considering that and diversifying their supply chains as a result. So now, when we put now, what is going to what is the macroeconomic framework that's going to emerge from these agreements? You can argue that, so some economists have argued that the trajectory is going to be around 0.35 to 0.4% of growth per year when you have when these um, when these agreements come into effect. But at the same time, it is not distributed. These gains are not distributed evenly. Like services and labor intensive manufacturing is going to have the biggest benefits. IT exports and textiles, pharmaceuticals, they're going to grow even faster than they would if they didn't even have these agreements. Now, on the other hand, heavy industry like steel and aluminum, for example, they are going to be facing a lot more pressure and competition from EU with more efficient producers. Now, in terms of agriculture, it's protected in most of these agreements. So while the protection is time limited, the farmers know that, and they may face global competition in the future, the agriculture sector is secured now for at least the next few years. Now, in terms of the balance of payments, it's going to tell a very important story on these agreements. So, as we've talked about, if capital inflows are too large, then the rupee appreciates and exports are less competitive as a result. Now, when we think about, oops, now, if we think about the partnerships that they're going to have with the UAE, this sort of patient capital, the strategic investments to the United States partnerships, it will improve their current account without exposing them, without exposing their portfolio to, any volatile or any volatility, so to speak. So now, if global interest rates rise sharply, given this, some of the portfolio's capital that flowed into India are going to receive that are seeking higher returns could create liquidity stress and reverse its investment very quickly. So managing these flows is very important for India to consider. Now, so to sort of understand the innovations that we've seen at this point, so India has been able to improve or expand its reach in its service sector while diversifying its supply chains and improving their investment in green energy and manufacturing to improve their export volume to other trade partners around the world because of what we saw with the United States. So India's strategy here with these agreements, it can very much be thought of as consistently hedging their bets in this case because of the reliance that India has as the United States is their number one export market. The impact of those tariffs showed that India needs to um, very severely diversify their supply chains, even as we've seen that it improved their standing in different sectors. So, I just to sort of wrap up all of this, what can a lot of countries, especially emerging economies, sort of learn from India's current experiments so far? Now, I want to be clear that I am not arguing India's got everything right or that these agreements are a template to be copied verbatim, but every country has different endowments, political constraints, strategic priorities. But these priorities from this experience are relevant to policymakers in Johannesburg, Jakarta, Nairobi, Brasilia, and beyond. So the first part is the impact of this liberalization. Do not open all the sectors at once. I think that's one thing that they should know. Start with sectors where you have proven competitive strength. So for India's case, their competitive strength was in their service industry, for example. So for India, they are more than eager to have duty free imports or on their service sector, but uh, you know, like but areas like food security, you know, or sectors that you realize that are weaker and need time to consolidate, mechanize and move into higher valued products, those are ones that you need to keep tariff rate quotas on. And you can read books like Kicking Away the Ladder. The United States did the same thing. And this strategy, um, using tariffs for your infant industries, that's something that they've used, every developing nation has used. So now I want to talk. Now, the second point is the negotiating these phase outs for these manufacturing sectors. So, one thing that is um, sort of apparent in these agreements is that the auto industry, but also um the auto industry in particular is very sensitive to these agreements. So if you open your auto sector overnight to imports from Japan or Germany, you're going to completely destroy your domestic industry before it has a chance to learn, invest, and compete. But if you phase in this liberalization over a decade with declining tariffs, interim safeguards, you give producers time to improve their quality, find export markets, and reduce their cost. But, you know, but this is not a permanent protection. That's the point. It's sort of training wheels, right? It's strategic patience. and it's how every industrialized country has actually developed. Now, the third big important innovation here is finance. And finance is very interesting because de-dollarization has been a very common topic discussed for very good reason. And it just shows that local currency settlement is not simply a symbolic gesture. It's become a very practical means. It's become a very practical means of reducing transaction costs, insulating trade from shocks from dollar liquidity. So if you're negotiating with another emerging nation, for example, like you would push for like Mexico, or you would push for rupee peso settlement system. If you're Kwanzaa real settlement, shilling ringgit settlement, whatever the currencies are, you build that payment infrastructure that we've seen really come into practice, especially within the last year or two. Educate your businesses and lobby your central banks to make it seamless as the dollar transactions have been before. Obviously, the eliminating the weight of the dollar will not be solved overnight, but the need to reduce its dependence is uh, is essential. So now let's also think about how the rules of investment are starting to change. So I talked about before about how the investor state dispute settlement model gave foreign corporations way too much power to challenge legitimate public interest regulations. So the new generation of bilateral investment treaties, like the one that India is negotiating, is going to channel these disputes through domestic courts first, including carve outs for industrial policy and climate and public health, which will also eliminate the most intrusive provisions that allowed investors to sue over regulatory changes. So if a developed country, for example, insists on this ISDS model, negotiators need to push back on that because alternatives exist and investment can flow without intrusive treaty protections, especially if, in this case, the Indian market is large enough and has strong growth prospects. Now, I didn't cover this as I should have today, but I do want to make a quick point about the um, the critical resource supply chain. If I can find the right one, here it is. So now, for India's sake, because they are trying to also get access to a lot of these critical minerals for their own manufacturing capabilities. So, for India's sake, they should not just export raw lithium, rare earths, or cobalt or copper. They need to focus on domestic processing, refining, and manufacturing, similar to China's model that they've been using for as long as they've had, including export restrictions, joint venture requirements, or local content rules to ensure that your resources generate jobs, as well as technology transfer and also building industrial capacity domestically, not just royalty payments. So it will create frictions with importing countries, but these resources are critical. So negotiating that is paramount. But for India, while um, if the alternative is just to remain a commodity exporter, they need to avoid that and adopt models where they are capturing the value added goods, or else they will be stuck in a cycle of underdevelopment. So now, uh, what about this model as it's coordinating through coalitions? So a lot of these economies, these individual emerging economies, have limited bargaining power, right? It's, when negotiating with countries like the European Union, the United States, or multilateral institutions, that's obvious. But blocks or not, but organizations like the African Union, ASEAN, Mercosur, BRICS can push back on this one size fits all template and demand respect and treatment, you know, uh, you know, treat others the way you want to be treated, essentially, and focus on creating alternative institutions for trade finance, development lending, and dispute resolution. It's not about confrontation, but the development of these alternative institutions to ones like the IMF and the World Bank will allow the emerging economies to have other options, and as a result, become way more stern in their negotiations with Brussels or Washington. Now, lastly, for Indian policymakers, it's important that they need to use this policy space to build that domestic capacity, and I think that's obvious with many of these free trade agreements. A lot of it is centered around building this domestic capacity. Trade policy is not development policy. Market access, foreign investment, and technology transfer are tools, but they are not sufficient to meet our needs. You need to continue to invest in education, skills, infrastructure, research, and innovation. And you still need to create and promote regulatory systems that promote this competition, prevent monopolies, and ensure that the gains from trade are distributed broadly, that is not solely captured by high wealth earners. So, even with all of this, with these agreements and how India has formed this macroeconomic framework and how they've diversified themselves as well as they have, this will not help them if their social policies, if like retrading programs do not meet the increased requirements that these agreements are going to provide. So they need to evolve too with the times. So with let me just close here. So it's crazy to think that the world economy is, there was a point in the 1990s and the 2000s where there was this sort of hyper-globalization. There was lengthy supply chains, capital was flowing indiscriminately across borders with minimal friction. But now we're in a completely new era, ended by the 2008 great financial crisis, the rise of China as a manufacturing superpower, the COVID pandemic, and the return of this rise in geopolitical competition. What is emerging is something messier. It's a network, fragmented, a global economy that is becoming more and more fragmented, where this sort of trade and investment are shaped by these strategic considerations, where different regions are building these alternative institutions and these payment systems where these rules are being constantly renegotiated. So for emerging economies, there is a massive risk, but also a massive opportunity with this. For for one thing, they do not emerging economies see this as a way to avoid picking sides between this US China competition, or what it's being marketed as. They can build south partnerships that will bypass these traditional intermediaries and allows them to use industrial policy without violating any rules from the WTO, that a lot of the United States has largely abandoned, and demand agreements that serve your country's development goals, not solely on the interests of importing countries. For India, this shows that it's possible to negotiate to preserve your policy space, to build deep trade and partnerships with emerging countries, to build strategic value in defense, in technology, or resources that secure investment across these sectors with low tariffs. But it also shows that even a large economy like India has its limits and has to make significant concessions to access these major markets. Even if the macroeconomic gains are real, how but modest, the domestic adjustment costs are will be substantial and maybe politically difficult for certain sectors and losers. So thank you guys so much for joining me today. I hope you found this story about how India's forefront trade strategy has showed how emerging economies can navigate this new decade of trade diplomacy. And it's still being written. And for the choices being made in New Delhi and Brasilia and Johannesburg and Jakarta, they will not just shape their own futures, but they will shape the future of the global economy itself. So thank you again so much for joining, guys. Please be sure to hit like and subscribe, and I will talk to you all again very soon.